Good morning, traders. Today is January 15th, Sunday morning, bright and early. We're dealing with a bit of rain out here, but we're loving it. California is at least getting the water that it needs to survive, and hopefully the rain will scoot on out of here in the next day or two, and we'll get back to clear, sunny skies with lots of snow in the mountains. Okay, this is the custom index video that I do every week. This is probably the longest one. It discusses the market sentiment. We're going to go over the market setup here. This is the ES. We've seen this nice solid rotation into a flagging formation. We're breaking a little bit higher right now above this downward sloping channel. We'll see if we have some momentum. The next couple of weeks could be very, very interesting. It looks like we have a number of issues starting to stack up, so be prepared. We could move into a moderate reflation trade up into this 4100, 4150 area, but we could also slide into some complacency, rollover, really go nowhere trending, depending on what earnings do and economic data and some of these issues that are setting up, particularly regarding the U.S. debt limit ceiling that we're going to have to contend with over the next couple of months. Okay. Let's go through the custom indexes. This is the accumulation phase index monthly chart. You can see here that we are moving fairly strongly upward in early January. Let me try this new feature, zooming in. You can see the rally phase here that we saw, the consolidation, the basing pattern that I highlighted, the end of wave 4, I believe. These are my Fibonacci time zones coming across. And then we have this end of major zone here, this blue line, and then this what's called capitulation zone here. And we are likely going to try to move away from this capitulation zone into kind of a moderate reflation trade, somewhere back up into this area, not nearing all-time highs, but somewhere up into this middle, let's call it from these lows down here up about 60-70% up into this area here, and that would require the lower accumulation phase index to move downward, to move slightly back downward into this middle channel here, and that's likely going to happen over the next 4, 5, 6 months. I don't believe we're going to see any major disruption event as the U.S. economy attempts to revalue going forward. So be aware that we are likely to slide into kind of a sideways, upward bias trend, in my opinion, barring any major crisis event. Next, we have the cash flow index. Big breakout to the upside. This is showing you that consumers are moving back into the markets. This is showing you that retail traders are coming back in. This is expected in early January, the first quarter of 2023. We'll likely see this revert back up into the 160, 170 area here, maybe over the first quarter of 2023, and then stall back out. Maybe attempting to get a little higher, but again, we have to be cautious of some sort of a disruption event coming back. We've seen a very solid recovery. While everybody was still warning of a massive crash, we've seen the markets rally from these levels, you could say almost 50% on this chart. Reality is I think it's been closer to 14, 15%. But again, we're getting a very solid reflation trade to the upside. Really good upward move here, particularly after we saw this deep, deep low down here near these COVID lows. Remember, this was, entire shutdown of the globe right here. Then we reverted back out of it with the fact that the economy was still going to function. This was a capitulation low back in August, September, October of 2023. And I think traders started to realize that this was enough. This was enough to the downside, given the fact that the economy is still functioning, the Fed is raising rates, and given the fact that the U.S. economy is still fairly strong, and really this becomes a crisis, a credit, debt, bonds crisis for foreign markets, less for U.S. markets. So we could see a good solid reflation trade in the U.S. still. Consumer engagement index, here's the capitulation low again, end of the year 2022, good solid rebound to the upside. You can see we're getting this rolling to the upside here with RSI and stochastics. In reality, ladies and gentlemen, we got a long ways to go to get back up above this channel. It could happen, could just rally back up to this channel, stall back out before it attempts to move upward. So be aware that we're going to run into resistance across this purple line here and probably back over in this area. Right up where I'm pointing right here is where I likely think we're going to end up finding some resistance by April, May, June. And then we could stall back out. This would still be fairly bullish. Back over in this area would prompt maybe another 8-10% move to the upside in general U.S. markets. But we're still, let's say, taking on water. We don't have a clear upside bias yet. This is really good, though, indicating that consumer engagement is kicked back up. So we could see a nice little move back up here over the next 60 days, and then we could stall back out in this area. We need some sort of a real catalyst at this point to break to the upside. We don't quite have that yet. May not have that until the end of second half of 2023 or maybe into early 2024. Okay, next we have the large cap index. Basing, stalling, very good to see here. We definitely don't want to see the large caps start to move downward any further. This has been historically a very solid correction to the downside. Historically, you can see here that we've gone through similar correction periods. This is essentially a 1.2 to 1.4, so that's going to be about a 24% correction. That's a pretty big move, ladies and gentlemen, given where we're at. We could see a breakdown event. That would be some sort of a crisis event taking place. But in reality, if we start to see upward movement in the other custom indexes, I would expect large caps to try to base, kind of like doing what we saw right here, or potentially right in this area. Base, try to move back up, maybe consolidate for about 6-8 months, and then attempt to reflate a bit higher. So that means we'd likely see this base and bottom move back up into this 137, 136 area, maybe start to move back higher through the second half of 2023 into 2024, and then start to accelerate upward. Next, the global asset index is doing kind of the same thing. We've had a fairly substantial base and bottom. You can see how deep these are. You can see we've seen these deep corrections before. Unless something really affects the U.S. and global markets. Now, understand that we're probably moving into an austerity period throughout the planet, and it may last 3 to 5 years. But that doesn't mean that the economy is not going to function. Austerity, in the best sense of the term, means that we are going to get a handle on debt. We may see some waves of defaults throughout the world, possibly even in the U.S. It may restructure valuations for hard assets like real estate, cars, and gold and silver and things of this nature. But it is really a good thing. It sets up think of it, an easy way to deal with it is to clear the books. It's like almost like a full audit. Clear the books, figure out what's going on, figure out what we got to do, make the necessary changes and process the time and price and valuation levels efficiently so that we can move into the next phase of asset price accumulation. And that may come after 2027, 28, 29. It may still be a 5-6 year phase of revaluation, very similar to what happened after the 2007-8 global market crisis, the GFC, the big U.S. housing and global market crisis. It took 6-7 years for us to move into a real appreciation phase. The gold custom monthly cycle index, even though gold and silver have been rallying, I'll show you that here in a bit, we're still in the early stage accumulation. It's really wild, honestly, to see gold and silver move up, 14, 15, 16% or more over the last couple of weeks, and to see this gold custom gold cycle index chart stay consolidated down near this accumulation phase. This means that we haven't even begun to see the real blow-off phase like we see here in gold and silver setup. This is where we start to see the real price appreciation. We're still in early accumulation. And if we're in early accumulation from roughly 1670 up to 1910, 1920, we could see this stay in early accumulation up to 2100, 2300, 2400, and then get into the big blow-off phase, meaning we could see $9,000, $10,000 gold or higher. So in reality, ladies and gentlemen, boy, if you're not into gold and silver right now, or if you're discounting the hedging capability of gold and silver right now, I don't know what to tell you. You really need to pay attention to what's going on. This could be just an incredible move over the next 20 years for gold and silver. My innovation chart is showing very solid bottom. You will remember back over here, I highlighted the chance of a base or a bottom, indicating that we have come down near these extreme low levels, and I could see back over here the same setup under COVID. Once we get down into this green channel, this historically presents very good opportunity for some sort of a rebound reflation trade, and sure enough, here we are. We got right down into these lows. We formed the support. This is the line that I drew on this chart a while back. But look at this. We're starting to get a good, solid rebound reflation trade. I think technology has a chance of reflating back up into this $90, $100 area here on this chart. And that would be essentially a 40, well, in reality, this is a 50% decline. This would be a 100% rally. You could see a 60, 70% rally in innovation, technology, undervalued technology in various sectors. So be aware, we're getting very close to what I think is a solid reflation trade. Initially, I'd be concerned about these areas here. You can see the support right here. So that's about 75, 76. And then the next phase is up into this 90 to 100% or $100 area. Still very exciting, good, solid, basing, bottoming. And again, this reflation trade could take a while. Could take 4, 5, 6 weeks, maybe 4, 5, 6 months, but it looks very positive right now. Okay, next. The custom fear index is staying lower at 6.85. We're starting to see some upward momentum here in the SPY. We're starting to see the sentiment index really start to move higher. We need to see it move above this center channel line, which is this brown line back over here. And in reality, ladies and gentlemen, this 400 level on the sentiment index would probably be the next level of resistance, assuming we can get above this trend moving stronger. That would push the fear index down probably to around 6.1, 6.2, maybe a bit lower, but that's a very good sign moving forward. Real estate sentiment index is still in extreme hostile territory. It's weakening a bit. This is really, I don't know how to explain this to you. This is the most hostile environment we've seen ever in the last 25, 30 years. I do expect this to recover, or let's call it revert, in a sine wave type format. Imagine this is a big sine wave. Smooth it out. Imagine it's just a big arcing sine wave. And I believe this is going to attempt to move down here into this 150 area, revert back up to maybe the 350, 300 area, and then revert back down to 200. That would mean home prices would move down into this 210, 220, 230 area, revert back up maybe to 280, 290, and then revert back down to say 230, 220 again before basing and bottoming. And that could take 3 or 4 or 5 years. So we just need to see this play out. But think of this as the most hostile environment ever that the U.S. has seen related to real estate. And the natural reaction at this point is price decreases, selling activity decreases. Really, it's going to unwind the real estate market fairly aggressively. And it won't start to really look attractive until we get down into this level here. Okay, next, the custom tech ratio index. Good, solid basing and bottoming. Really nice to see. This does confirm or help confirm my support that I believe we're going to see a reflation trade in technology. This could be over a 10 or 12 month period, so get ready for it. Looks like we're seeing a good, solid base and bottom in early 2023, just like I warned you about, that we could see this entire thing weighing out, capital moving away from risk, waiting for early 2023, and then redeploying in 2023. We'll see how the numbers come for Q4 earnings, but we could see a fairly solid move here, 7, 12, maybe 13% higher, but eventually this might be a 30, 40, 50% move to the upside or higher. Next, the U.S. To global index, and even though the lines are a little off here, pay attention, this line should be right across these highs. This is because I resized it, and this line should be right across these highs. But pay attention, just like the global markets led the collapse in the market, you can see here the global markets led the U.S. market, rolled over, rolled downward, indicating extreme weakness was setting up. We're now getting, just like in 2017, we're getting an upward move in the global markets, leading the U.S. market. We're getting the same upward move here, leading the U.S. market upward. If this trend continues and the global markets continue to lead the U.S. market, we're entering into a reflationary period, meaning the stock market will attempt to be biased to the upside. It will take a while to build momentum. We are not out of the woods yet, but this is a very good sign right now that the global markets, this orange line or red line, is moving substantially higher than the U.S. markets right now. We will eventually move into a period where the global markets will stall and the U.S. markets will take over from the global markets, kind of like in this stage. And then we need to watch for global market weakness. But this is a good reflation signal taking place that the global economy has reached a base bottom, is trying to reflate, trying to move higher, and it may take all of 2023 to actually move away from concern. So be aware that we could have quite a bit of sideways volatility throughout most of 2023 if my analysis is correct. Custom U.S. Valuations Trend Index, again, just as I predicted, we had that confluence low in December. Let me try to move over here. We had that confluence low in December back here. Double, triple bottoming at this point. Now we're starting to see some upward move. Would be very critical, very, very important to see this move back up to these levels, 2.25 roughly. And that would mean that we're getting a very clear upward bias trend. We still have a ways to go to get back up to all-time highs back here from 2020. But in reality, ladies and gentlemen, a reflation trade back up here into 1.7, 1.6 would be a healthy 40, 50% reflation trade through much of the undervalued technology and other sectors. Watch transportations, watch consumer staple products, watch shipping container activity. There will be very clear signs that the economy is reflating, but we're getting good signs of a base and bottom here, which is exactly what we want to see. But again, just like we saw back over here, we could see the base and bottom setup, and it could take 10, 12 months before we see a real solid reflation signal. So again, 2023 could be just basing, bottoming, maybe seeing a 20, 25, 30% rally in various sectors, and then moving into 2024, 25, 26 rally phase, which, believe it or not, is what I've been telling you now for, what, about 6 months, based on my cycle patterns, maybe even longer. So everything is lining up just like I've been predicting for many, many months. Next, we have the U.S. Leading Market Index. Nice solid move to the upside. You can see here, very, very extensive upward move. We're getting up above extreme channeling here. So understand, we come back over here, 2018. This is kind of historic extreme. With the Fed raising rates and with the markets devaluing and restructuring, I want you to understand that the real reality here is that we may see just a moderate upside move with this leading index. It may move up to this 2.3, 2.4, 2.5 level right up in here over the full 2023 year. And that would mean that we could see this move stay in this upper channel, kind of like we saw back here, stay in this upper channel until we reach some sort of an extreme and then consolidate and then maybe roll higher. So ideally, this is great to indicate that we're in a solid reflation trend. It looks like we're moving higher, but again, once we start getting up into these extremes, up into these unknown territories, there's got to be some catalyst to push this higher. Right now, we've got a hawkish Fed. We've got a revaluation cycle taking place. We've got some concerns with the U.S. debt ceiling and others. So I'm not uber bullish right now. I still believe a reflation trade is capable, 6, 7, 10, 15% higher maybe. But I'm really leaning towards the idea that 2023 is going to be more of a sideways consolidation phase, meaning it's just going to bias a little bit upward, maybe 10, 20% higher, and then roll around sideways until near the end of 2023. Okay, volume ratio index, a little bit weaker. That's fine. It's just basically a moderately slow week for volume. I told you that I would like to see some sort of a spike above 7, 8, 9, 10 last week. I would like to see something indicating big numbers to the upside or big reflation cycle bullish trending, but we're just not seeing it yet. So we had this little blip at the beginning of the year. Now we're consolidating. We're still relatively bullish. It may happen over the next couple of weeks. We just have to sit for it. The other custom indexes are showing positivity, positive upward trend. Gold to commodity. Okay, here we have a fairly solid reflation cycle. You can see here this big upward bar that took place last week. I'm going to tell you right now that this could carry for 4, 5, 6 weeks, maybe a bit higher. But I do believe the hawkish Fed and the overall revaluation cycle will again deflate this back down into 1.8, 1.7, 1.6, probably by June, July, August, September of this year. So this is a bit of a reactionary phase to this tight consolidation. We've got a lot of money moving back into the markets in early 2023. I believe we might see some carryover for the next 3, 4, 5, 6 weeks. Then we may see this roll back down into a consolidation phase. Lumber moved up last week. Gold moved up last week. Commodities could enter another reflation phase, maybe back up into like these areas over here. But I don't believe it's going to be long lasting. I think it's going to eventually wane back out in the 1.6 to 2.2 area and stay fairly consolidated near that upper range. Next, the custom metals trend index. Here you go, folks. If you have not been paying attention to metals, get ready. And the next phase for metals is going to likely see gold push up above $2,300, $2,400, maybe up in the $2,600, $2,700 area. Silver's probably going to push up above $2,930, $31. That's going to likely happen over the next 12 to 24 month period. Then we'll enter another consolidation phase. So think of this move as all of 2023, part of 2024, potentially getting gold up to 24, 25, 2600. Then we will likely consolidate back down to 22, maybe 23, maybe 21. And then the next phase for gold and silver, ladies and gentlemen, is going to push it up above 35, 3700. And that's going to be likely by, let's call it 2025, 26. Then we'll get a consolidation phase. Then the next phase is going to go up above 8,000, 9,000. Then a consolidation. Then the next phase is where we get into the real blow-off cycle. Now, I will preface this, during this revaluation cycle phase, which I do believe is very similar to 1940 through early 1950s, where we saw the markets attempt to restructure and revalue core elements of the economy, a very what's the word I'm looking for? Let's call it a very functional reestablishment of norms. It's almost like we're going to be moving away from all of the excesses we've had over the last 35 years and revaluing towards core elements of the economy. But that is going to provide a very big catalyst for metals. The unwinding of all of these excesses could take 10, 15, 20 years, could result in a number of credit crisis events throughout the globe, could also prompt a very big move in metals. I don't know how to explain this to you, but $9,000 gold is not unfathomable. the crisis event that has taken place, the moving away from a gold standard in 1971, moving into a credit standard, and the unwinding of that credit standard is likely going to prompt safe haven asset rallies, commodity rallies in various stages, potentially even emerging market cycle phases that we're even unaware of. But gold and silver and precious metals are likely going to be some of the biggest beneficiaries over the next 7 to 10 years of the unwinding cycle phase taking place. So be aware. It's going to go in stages. It's going to go one rung, ladder rung at a time, but it could be incredible. The FANGs index is stalling out, still trying to base. We still don't have any white bars. TradingView kind of changed the symbols a bit, so I'm kind of questioning these black bars, but this is telling us that essentially we're finding support, we're moving slightly higher. You can see we're in an uptrend, but we're not seeing real follow through back to the upside. We'll see if this changes and how it changes moving forward, but we've reached these extreme lows, these historical base bottom patterns, and now we could see a reflation trade back up in this 350, 360, 370 area back over here. And that would be a pretty good upside move. That would be another 14, 15% to the upside. Bradley Custom Metals Index, here we go. This is more tied to the price of gold and silver and platinum, but the rally phase is fully in effect. Okay, this is breakout gold, silver. You can see this rally taking place. Zoom in here real quick. You can see the base bottom, the initial impulse move, the consolidation, the breakout trend right here. Now we're into real solid rally phase. So again, all of those guys that are telling you that, you know, metals, wait for it, should have been into it back over here. Will there be a pullback? Yes, there will. There will be a number of pullbacks as we move forward, but understand that the real long-term cycle phase is that we will enter these rallies, consolidation, rally, consolidation, rally, consolidation, rally, consolidation. So you will eventually possibly be able to buy back near these levels right over here. But if you have not taken a position in metals, if you have not started your physical collection, I strongly suggest that you talk to some local dealer, go figure out how to get your hands on some bars or some coins, even if they're half ounce, quarter ounce, what have you. Long and short of it, physical metals, not just the paper metals, but the actual physical, tangible that you can get your hands on metals are going to enter into a very big move here as this unwinding phase continues. So be aware, this is a huge opportunity, and I want you to know that I've been warning about this for 2.5 years, way back over here, way before COVID, way before this whole thing took off. You need to understand what's likely to take place. We're exiting an unwinding phase of global excesses where central banks prompted and pushed huge amounts of money, paper money, credit into the market, and that's going to unwind. That means that hard assets, hedging assets like gold, silver, platinum, palladium, these are all going to really do their job, do what they have historically been doing, which is hedge risks of credit default and credit market collapses. Again, just a huge opportunity. Okay, Smart Cash Index, this is the global market index, got above my resistance channel here. Really super positive, but we do need to see this reflate. You can see back over here this trend line that I've drawn many months back, early 2022, and really, ladies and gentlemen, as long as we stay below this blue trend line right here, we're in a moderate upward reflation trade, but we could trade sideways, as I mentioned to you, over the next 6-7 months. So be prepared for some sideways trading as the global markets try to figure out what comes next with the unwinding of the excesses. This is not going to be a big solid, you know, blow your socks off rally, in my opinion. I think we could be looking at 6, 12, 15 months of sideways consolidation with an upward bias as we start to try to find our footing for upward movement, continued upward movement. Next, okay, the Rotational modeling system is still weekly bullish, daily bearish. That nets us into a 50% bearish position, 50% cash. You can see here, I will show you the SPY is still bullish. This is the rotational modeling system at work here, still bullish. The daily down here is bearish, getting some topping signals here. We could move into bullish trending very quickly. It doesn't take much once we get into these topping signals here to move us into bearish. Now, sometimes we will flip on upward trending here, but we are now getting to the point where if we see a couple of up bars, hypothetically, close above 406, 407, 408, there's a very good chance that we could see the rotational modeling system move back into a bullish trending scenario. And that would be stupendous. That would potentially get us back into a reflation trade, back up into this area here. But I want to warn you that we still have concerns regarding risks, credit, global central banks, what have you. So we're not in the same boat. Think of this as zero interest mania. This is not zero interest mania here. This is now we have an unwinding cycle that's likely to take place. I've gone through this before in the rotational modeling system and real estate video. We have a very good chance that we're going to see this sideways consolidation phase as long as we do not have any crisis event take place. If we have a crisis event take place over the next 12, 24 months, we could easily come back down into these mid-COVID lows down here and potentially try to find support down in this area. So barring any crisis, we're just going to melt upward and attempt to eventually break out the highs. If we get a crisis event over the next 12 months, 24 months, we could see this break downward very easily. That's why I'm telling you, we are not out of the woods, out of the storm. We have to be very, very cautious. Okay. Next, we have the allocation levels. We're 20% stocks, 55% cash, 25% metals, which is acting as a perfect hedge right now, 0% bonds, and stocks. We're 20% stocks, 80% cash, and 0% bonds. This is the alternate if you can't buy metals in your portfolio. Obviously, ladies and gentlemen, metals need to be part of your portfolio. I just gone over that looking at the metals charts, but if you cannot buy into hedging, I strongly suggest you go start your collection of coins and bars. Try to find even jewelry. I've been doing this now for the last 9, 10 years. Back in 2010, 11, 12, I started buying physical gold, silver, and just stashing it. And the point behind that is because I believe that we're entering into a broad crisis phase, a broad unwinding phase. It's part of an 85-year cycle, I'm very confident that we're going to see gold above 5,500, 5,700, even slightly confident that we're going to see it above 8,000, 9,000. So understand that we're getting into a phase we have not seen ever. There's never been a point in time where the world has gone through this type of a cash infusion event and then tried to move into an austerity mode to move back into security. And I think gold and silver are going to become the hedge du jour. It's just nobody really understands it yet. Okay, the U.S. Custom Weekly Index, big breakaway trade. Look at this move here. Big rotation to the upside, broke through that apex that I was talking to you about. Now we need to see what happens next week. We could see some follow through. In fact, I would expect a bit of follow through next week as early earnings come out. But we really have to be cautious of the upside potential. You can see this channel that we have here moving higher. Now that we've broken out, we've got to see whether we get any follow through to this and if we're able to get up into this area here. And this would be the next channel of resistance right here. So that would put us at 11,700 roughly, 11,800. And that would hypothetically be about an 8% move upward in the markets. That could be our next channel of resistance right in this area. And that means that we potentially have a fairly solid move before we run into resistance here, maybe 7, 8, 9, 10% for the SPY. And then we have to be very cautious because we could see it roll back down before consolidating and attempt to move higher. Okay, the weekly valuations index moved a bit higher. We did not see any big upward movement here like we've seen in others. This means that we are not seeing the actual stock market reflect proper valuation as we are seeing with the sentiment index and the cash flow index. This would likely take place as a move up above this red line over into maybe 62, 63, 64. But understand we're not seeing that valuations move higher, meaning that we're not seeing broad capitulation asset appreciation. It's early stage appreciation in the market. We're not seeing broad stage appreciation in the market. That's something that will likely come when the market moves away from this early stage rally phase. And then what would happen is we would start to see some appreciation from these lows back to the upside. You can see we've seen a little bit here, but we need to see some real consolidated upward trending. That would move us into a real solid appreciation phase. So at this point, another 10% move higher. So we're at 59.29, call it moving to 64.50 or a bit higher. That would be a substantial move indicating that valuations are starting to capitulate with the other indexes moving higher. That would say we're moving into a fairly solid upward trend. Custom volatility index, again, my favorite. Look at this move higher, just like I talked about last week. We ended the 5-wave structure. We went from these lows, COVID lows, all the way up to these highs as 1, all the way down to these lows as 2, 3, 4, 5 up to here, consolidated. Now we get our breakout. This is a very solid, big breakout trend, everybody. We need to see how this moves. Remember, this is not the same COVID low, zero interest rate move like this. So where do we go from here? My opinion is we consolidate between 9.5 roughly and 12 over the next probably 5, 6, 7 weeks, if not longer, attempting a bullish bias, attempting a melt up cycle. This is very bullish. We've moved away from this channel. We're attempting to establish a new channel. But I think what we're going to do, ladies and gentlemen, is move into, if I were to give you an analogy, which I do a lot, think of this as we've broken away from the pack, the downward cycle channel. We are now moving at about 20 or 30 miles an hour in an upward channel. In my opinion, we're trying to gauge our footing, move away from the risk concerns. That means we could stay safely in the 20 to 30 mile an hour range, meaning this volatility index would stay somewhere between 9.5 and 12 over the next couple of months, maybe through the end of the first quarter, and then maybe begin to appreciate back up into this 13, 14 area. And that would indicate fairly extreme bullish trending up in this area. So I think we're going to stay in moderate bullish trending for the next probably 6, 8, 12 weeks, then slowly move into this 12, 13, 14 area, which would indicate very strong bullish trending. Okay, so overall, where are we, ladies and gentlemen? We're in this mode here. And as I've been telling you, we have this wave 4 correction down here. We've seen the beginning of a wave 5 move. But as I've mentioned to you, and I've highlighted with this box in the last video, I think we stay in a fairly range-bound mode over the next 14, 15 plus months. I think we stay in this range-bound sideways trend, potentially seeing the markets move in this channel, possibly, let me draw this, possibly moving back up here, stalling, coming back down, rolling around, and then attempting to move out. Now notice where I've drawn this. This is March 2024. I think this end of year cycle phase here, March 2024, this is what's likely to be required. Let me spread this out. This is what's likely to be required to unwind what the Fed is attempting to do and let the global markets unwind their credit debt excesses. And I believe that's going to present a fairly solid consolidation phase here where we see the markets move. Now remember, these are 8 to 15% price swings in the markets, but I think we're going to start to see more clarity once we know what's going on with risk events into 2024. Now this, again, 2024 enters an election year. 2024 way out here in, let me draw it here, November, right there is an election year. Draw that in purple because we need to be aware of it. Election years, the year and a half or 2 years before a major election year are typically very flat. Okay, this moves us into a consolidation phase where we may see this gold box as the consolidation phase for this year. Then we may see, hypothetically, this kind of a range, and I'll do this maybe in a different color. Let's try purple. This range here as the pre-election range. So hypothetically, if we stay in this range like I've drawn here till early 2024, move into the election year, depending on how the election year is going, what's happening, we could see the markets move up into this area prior to election year. When election year happens, depending on what happens, we could see a big move in metals and a big move in the markets. More than likely, we are going to continue to stay in an austeric period for the next 2-3 years. More than likely, we're going to try to be unwinding the global excesses. We're going to be unwinding debt. The best way I could say it is the entire world is going to try to eliminate excess credit debt risk and move back towards a non-zero interest rate function, which is going to likely take 12 to 24 months minimum to execute. But the reality here is we're into the pre-election cycle. We're now literally, well, if I do the math real quick, 22 months away from the election. And I do believe that if you were to take a look at this, even though my drawing may not be 100% accurate, I believe this is pretty much where we're going to be. Now, if we get crisis events, like hypothetically, if some global economy like Japan or some other has some sort of a credit crisis, we could see these things kind of spike to the downside in those types of events, which is very similar to 2015-16, where we had an extended sideways consolidation. This period is very difficult to trade for quantitative or logic rules-based trading systems. Rules-based trading systems get chewed up in this time frame. So understand, unless you have a quantifiable model that can adapt to what's taking place, rules-based systems will get chewed up for the next 4 or 5 years, maybe. Because once we get to the election, which remember, the election takes place in early November, transition of power takes place January 20th, roughly. So at this point, we get a transition of power, and at this point, ladies and gentlemen, now we have a whole series of unknown. Is it unknown this way, or is it unknown this way? What do we see as the next phase for the market after the elections in 2024? Okay, that's your update right now. Follow me. I did want to show you this. I showed it in the last video, but I'm working on a 30-minute, an intraday TT scanner system. And I mean, it's pretty much the same TT scanner system that I run the TT scanner hot lists on. But understand that this is something that I'm likely going to put together that will help you trade shorter term trends. It will be offered as a separate product. I'd like to know what products you'd like to see, what symbols you'd like to see. Obviously, QQQ, QLD, gold, silver, innovation, SPY, but long and short of it, you know, these are going to represent basically 2 to 4 hour swing trades to 2 to 10 day swing trades, and they can be as big as you can see here, 2%. Let me show you. This is our entry price. This is the newest trigger here. This is in XLF way over here, but you can see the actual percents of these are targets. This is our stop. This is our in-trade profit here. This is our entry price. So you can see these are 11 bars, 16 bars, 21 bars old. They're half-hour bars, 30-minute bars. So these represent essentially a day and a half. This would represent essentially 2 days. But you can see we're getting 3, 5, 2, 7, 9, 10% swings in the market. And when we catch some really big ones, like IGE and XHB, you can see we can catch some big moves over many, many days. These are approximately 7, 8 days old. We've already hit our targets. We got in it at 40.06. Our stops at 40.85. We've hit our targets here. We have our current price at 42.50. These are great swing trades. Now, the idea is, you know, would you be interested in these? What would you like to see? What types of symbols and lists would you like to see? And would you like to see it delivered as a mobile app or a web page or whatever? Let me know, because the algos I have, and again, this is what I do for you. I develop solutions, and then I try to deliver those solutions to you, and then keep you abreast of what's going on, giving you access to all these trading signals and allowing you to decide what to do. So I like to say, I do the research, you make the decisions. The whole point behind that is that I want you to be aware of how you can take my proprietary technology and execute it any way you like. But long and short of it, I've been giving you guidance, telling you what to expect. I've been putting all of it out there in public so that it lasts and we can use it as an anchor reference point. And if I'm wrong, I'm wrong. If I'm right, I'm right. So far, I like to think that I've been right more than I've been wrong. But the long and short of it is I'm looking at this 30-minute TT scanner setup and thinking about how I should deliver this to you as a solution. This would be the first time I've moved into intraday trading. Maybe I set it up as a stock trading system under Collective 2 or some other shared environment. But the whole idea here, ladies and gentlemen, is these work. They offer you the opportunity to control your allocation into the systems, and they give you the ability to trade in any market trend, daily, weekly, intraday. So let me know what you think. Share your comments, email me. Let me know what you think. The long and short of it is I believe this would be a great way for you to move into the next phase, which is intraday swing trading, possibly options trading as well. Okay, remember, share my videos. Let me know how I'm doing. Give me your feedback. I love hearing from you. And, last thing I wanted to do was go over this. I'm sorry this is so long, but we are getting ready for the next phase. We just completed this major crush pattern here. Now, take a look at this. We're getting into gap potential, gap reversal. Breakdown is the next week. That's actually today, and then tomorrow is a holiday. So we get a potential breakdown on Tuesday. Then we get a pop on Wednesday, nothing on Thursday, and then a base rally on Friday. Then Saturday, Sunday, we get a breakaway rally, carryover, which should mean we're going to move into a rally phase. Inside breakaway, harami, another crush pattern, and then a reversal rally. So the next phase here, even though Tuesday we get this breakdown pattern on my SPY cycle patterns, after that, we start moving into some real solid bullish trending. And look over here, we get reversal rally, then we get 2 days of nothing, inside, breakaway, breakaway, rally, rally, carryover, crush, reversal rally. Oh boy, that carries us all the way into February, meaning the next 2-3 weeks are rally, 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 rally. We get one potential pullback on Tuesday, but we get rally, 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 rally. Then we get our first top consolidation February 14th. We get a bit of rotation, then we get breakaway, carryover, crush, flat down, pop, base rally, crush, bottom, major crush. So this is rally phase into mid and end of February. And oh boy, I mean, this could be really powerful. Please don't get married to a short position until we get any type of real crisis event setting up. It looks like we're going to move into a really solid melt up rally phase over the next 45 days, carrying into the first quarter earnings of 2023. In fact, if we look over here at the end of March, we get rally, momentum rally, breakdown, rotation, top resistance. So we get a little bit of resistance in early April, consolidation crush, top resistance, bottom, top resistance. So we get a lot of warning here in the first week and a half of April. And then we move into flat down, momentum rally, gap up, consolidation, inside breakaway carryover. So the early part of April could see some real consolidation, downward trending. Until then, we get a lot of momentum rally, gap up, rally, carryover, temporary bottom, little top here, breakaway, rally, weekend gap reversal, breakdown, flat, rally, weekend gap again, momentum rally. So we get a rally pretty much all the way through February, mostly through March. Nearing the end of March, we start getting into some top patterns here and here, but that's really at the end of March. Then we get into some early resistance and consolidation in the first 2 weeks of April. So April, call it 1st through 16th, 17th, 18th, we're getting some real consolidation. And that would look like this, ladies and gentlemen. If I were to come back over here and drag this over here. So this is the ES. And if I were to give you an idea of what we would expect, we would see some upward movement, consolidation, upward movement into February, consolidation, upward movement into March, consolidation, upward movement, and then into April, which is where we're at right here. This gets us into April. We would be looking at the potential for some consolidation headed into early April, maybe around this area before we start to consolidate and move back upward. So that gives you an idea of where we're at. Does this put us into new all-time highs? No. Does this put us into, oops, whoa. That was quite funny the way it just crammed in there. So does this mean that we're getting into all-time highs or rallying excessively? No. What it means is we have approximately from current levels, call it 3960 up to here. That would be doing the math really quick, about 11%, 12% upside move. And then we start to consolidate over here. Then in April, May, June, we'll see how we play out. That's why this is really a fairly solid line drawing, hypothetically showing us what to expect. Is we could see this type of a move based on my SPY cycle patterns, whereas this is a more consolidated general cycle trend, maybe moving into a new high territory in 2024. But I don't think we're going to get into new high territory until the middle end of 2024. I think we're going to stay in this consolidation phase for a period of time. Okay, a little bit of a long video. Share it with your friends. Tell me how I'm doing, and let's look forward to making this a really great next couple of years, okay?